Welcome, deep divers. You've joined us for, well, a really crucial conversation today. It sits right at the intersection of innovation, security, and frankly, a colossal amount of money. Today, we're taking a deep dive into the world of anti-money laundering, AML, and Know Your Customer, KYC, specifically how they're reshaping the incredibly fast-paced payments industry. Our goal for you is pretty simple: cut through the jargon, the immense complexities, give you a shortcut to really understanding the staggering costs and the constantly evolving challenges of financial crime compliance.
And it's not just complex, it's almost a paradox, a
Right.
multi-billion-dollar one.
hmm
What's truly fascinating here is just how much is spent every year trying to combat financial crime. It's a staggering amount. And yet, despite all that spending, how much illicit activity still manages to slip through the cracks? It's quite something. We're talking about an industry often struggling with systems that, well, they just haven't kept pace, and things are only getting more intricate with the explosion of digital assets. This isn't just about ticking boxes for regulations. It's a serious global effort against criminals, against terrorists. The stakes for the integrity of our financial systems couldn't be higher.
That's a powerful way to put it, a multi-billion-dollar paradox. Now, AML and KYC terms we hear all the time in the financial world, right? Often used almost interchangeably. But for those of us who follow this space closely, we know there's a really crucial distinction. It's key to understanding effective compliance. Could you maybe just quickly lay out that relationship for us and perhaps touch on a common misconception?
Absolutely. Yeah, the misconception is definitely that they're the same thing. But fundamentally, AML is the big picture, the overarching framework. Think of it as the entire set of regulations, policies, procedures, all designed to prevent illegally obtained funds, the proceeds of crime, from washing into the legitimate financial system. It's a massive global effort to protect that system from being exploited. Yeah. KYC, Know Your Customer, is actually a non-negotiable part of AML, a subset, really. It's the foundation, the first line of defense, you could say. These are the mandatory steps that financial institutions, payment service providers must follow to verify who their customers actually are. The main goal with KYC is to understand a customer's true identity, their business activities, and crucially, the level of risk they might pose. A strong KYC process is, well, it's literally the bedrock. Everything else in AML builds on that. Get KYC wrong.
And the whole thing falls apart.
Pretty much. Everything that follows is compromised.
Okay, so if KYC is that foundational bedrock, what does that actually mean in practice? Like, how do businesses verify us or other businesses when we sign up for something new? Is it always the same process?
No, definitely not one size fits all. It's very much a tiered approach, and it's all driven by risk assessment. We start with the basics for everyone. That's customer due diligence, or CDD. Collecting and verifying essential info, name, address, some kind of official ID. For businesses, it gets a bit deeper. It's about peeling back the layers to find the real controllers, the beneficial owners.
Ah, so not just the company name, but who's actually behind it.
Exactly. Anyone who ultimately holds, say, 25% or more of the company. It's about stopping criminals from hiding behind shell companies. Now, if a customer is assessed as minimal risk, maybe we can streamline things with simplified due diligence, SDD. But conversely, for higher risk profiles, think politically exposed persons, or maybe a business in a high-risk industry. That's when enhanced due diligence, EDD, kicks in. That requires a much deeper investigation, looking into their financial background, sorts of funds, any significant transactions. And this is critical, AML KYC isn't just a one-time check when you sign up.
Right, it's ongoing.
It has to be. It's a continuous dynamic process. It demands ongoing monitoring of customer activities, transactions, even behavioral patterns, things like weird money transfers, suspicious login attempts, sudden big changes in spending.
That makes total sense from a regulatory perspective. But thinking about it from the company side, or even ours as customers, isn't there a risk? Like, if KYC is too strict, could it actually turn away good, legitimate business? How do you balance security with, not making it impossible to sign up?
That's a huge tension, absolutely. And it's precisely why that risk-based approach is so vital. SDD for low risk, EDD for high risk. But back to your point about getting KYC right initially. A flawed process at the start can have these cascading negative effects. It costs companies way more than just losing one potential customer. Think about it. If you misclassify a high-risk customer as low risk, or you don't properly identify those beneficial owners.
Monitoring afterwards is based on bad info.
Exactly. The entire subsequent AML monitoring system is operating on a false premise. This directly leads to what we often call an avalanche of false positives. Legitimate transactions get flagged constantly, creating this massive operational drain.
Wasting time and resources.
Immense amounts. And Even more dangerously, it significantly increases the risk of false negatives, where genuinely illicit activity slips through because the initial risk profile was just wrong. So yeah, the rigor of that initial KYC directly impact the effectiveness, the efficiency, and ultimately the integrity of the whole compliance program. It's not just ticking boxes. It's about getting a clear, accurate picture right from day one.
Okay, it's clear then. The whole AML program really hinges on getting that initial KYC right. And as you said, this isn't just one country's problem, it's global. So how do we ensure consistency? How do we coordinate this fight across such an interconnected financial system? Who's setting the international rules here?
Right, that's where the Financial Action Task Force, FATF, comes into play. It's the main international standard setter, an independent intergovernmental body that really guides the global efforts against money laundering, terrorist financing, and even the financing of proliferation, preventing funds from going towards weapons of mass destruction. It's serious stuff.
Stopping the money flow for dangerous weapons. Makes sense.
Yeah, absolutely. So their FATF recommendations are essentially the global standard. They provide the basic framework that countries then use to build their own national laws and regulations. A key part of their approach, a real cornerstone, is the risk-based principle. This means countries, institutions, they have to identify, assess, and understand their specific risks. Then they need to mitigate them proportionally.
So it's not just a rigid checklist for everyone.
Exactly. It moves away from that kind of tick box mentality towards a more adaptive, focused strategy based on actual risk.
Got it. So FATF sets the global standards, the principles. Governments then turn those into actual laws. But what does this look like on the ground, say in major economic hubs? And more importantly, what are the specific changes happening right now that businesses really need to be aware of for, say, 2025?
Yeah, the implementations vary,
Yep.
but the trend is definitely towards stricter enforcement and, interestingly, greater personal accountability. In the United States, you've got regulators like FinCEN, OCC, OFAC running things with the Bank Secrecy Act, the BSA,
Yeah.
as the foundational law. A big update coming for 2025 is around beneficial ownership information, BOI. It must be filed using a new API. Those old batch CSV uploads, they won't be accepted anymore. That's a clear push towards digital integration.
Okay, forcing a tech upgrade there. And penalties?
Can be hefty, up to US $2.5 million per violation. Then, over in the United Kingdom, you have the FCA and OPBAS as the main regulators. For 2025, a key change is that enhanced due diligence documents that EDD paperwork will need to be kept for 5 years. And there was a recent case that set a precedent with a massive fine, something like $264 million.
Wow. Okay, and the EU.
Right, the European Union.
Yeah.
Their framework covers all 27 member states, guided by their anti-money laundering directives, the 4th, 5th, and now the 6th AMLD. What's really significant there for 2025 is this focus on increased personal liability, meaning directors, compliance officers, they could potentially face actual prison time for compliance failures. That really underscores how seriously they're taking it.
So across the board, we're seeing this global shift. Stricter enforcement, yes. Technological modernization, definitely. But also this very pointed emphasis on personal accountability. It's not just the company paying a fine anymore.
Exactly. That trend is undeniable. Compliance is becoming a very personal responsibility, right up to the leadership level.
Okay, so we understand the why and who sets the rules. But let's talk money, because the cost of this global fight, it isn't just significant, it's, well, you used the word staggering before, and it seems appropriate. What kind of numbers are we actually talking about?
It's an immense burden, honestly,
Yeah.
and one that most people probably don't even realize. Globally, financial institutions, fintechs, they're estimated to spend somewhere around $206 billion per year.
Billion, with a B.
Billion, with a B, every year on financial crime compliance. The costs are mainly driven by two things, labor and technology. And staffing is usually the biggest chunk of that. Just look at the trends. Compliance expenses surged over 60% since the financial downturn, and the actual employee hours spent on compliance, up 61% between just 2016 and 2023.
That's a huge jump in people power.
It really is. Imagine the scale of human effort just dedicated to this one area.
Wow. $206 billion a year.
Well-
That's genuinely mind-boggling. But is all that spending actually effective? Going back to that paradox you mentioned, billions spent, yet crime still slips through. It makes you wonder, are there hidden costs? Are there inefficiencies baked into the system that are actually hindering progress?
Unfortunately, yeah. A lot of that spending is actually a symptom of deep inefficiency. A central problem, one we touched on, is that avalanche of false positives coming from older, rule-based monitoring systems. These systems just flag huge numbers of perfectly legitimate transactions as suspicious. I remember seeing a study from a global bank. Their analysts spent, on average, 4 hours investigating each alert.
4 hours per alert.
4 hours. And the vast majority of the time, they were ruling out false hits, false alarms.
That's incredibly wasteful.
It's an enormous operational drain. It inflates costs, obviously. It slows down the response time when there's a real threat. And it causes reputational damage when legitimate customer payments get delayed or, even worse, blocked. Think about it. 4 hours on one false alert. How many genuinely suspicious things might get missed in all that noise? It's almost a tragic irony. And this massive volume of, frankly, low-quality alerts leads directly to alert fatigue, burnout among compliance staff.
They just get numb to it.
Exactly. They get desensitized, which, of course, increases the risk of missing a genuine case when it finally pops up. This fuels high employee turnover, loss of valuable expertise. In fact, something like 77% of compliance leaders said staffing shortages of skilled AML professionals was their biggest headache. And a huge part of why this happens is the reliance on legacy systems, old tech. Over 30% of banks openly admit their AML systems run on outdated infrastructure. These systems struggle with integrating data properly. They struggle with the high alert volumes. It just perpetuates this whole inefficient cycle.
It sounds like a truly vicious cycle. The systems create too many alerts, so you hire more people, but the people get burnt out by the bad alerts and the real threats might get missed. The fix more people just seems to deepen the systemic problem. So if that's the diagnosis, how do we break that cycle? If the old way is clearly broken, what's the solution?
That is the question driving the industry right now. And the answer, increasingly, is technology. These systemic challenges have really spurred a critical move towards leveraging artificial intelligence, AI, and machine learning, ML. These technologies are genuinely revolutionizing AML and KYC. They move beyond those old, rigid, rule-based systems. They offer something dynamic, scalable, and significantly more accurate. AI-powered tools can analyze just massive amounts of data, spotting patterns, finding anomalies, far more efficiently and precisely than humans or those legacy systems ever could. It finally offers a path to break that costly cycle.
Okay, so AI isn't just a minor tweak, it's a fundamental shift in approach. How exactly is it being used? Like, practically, how does it fix those problems you described, like the avalanche of false positives?
Well, it's being applied right across the board, throughout the compliance life cycle. For transaction monitoring, AI can identify really complex patterns looking at volume, velocity, value, relationships, all in real time. It spots unusual behaviors that simple rules would completely miss. For customer due diligence, CDD, you're seeing AI combined with robotic process automation, RPA. They automate those super labor-intensive tasks, data entry, checking documents, initial risk scoring. This massively streamlines onboarding, especially for low-risk individuals.
Making it faster and easier for most people.
Exactly. And directly tackling that false positive issue we talked about. ML algorithms learn from historical data. They get better and better at telling the difference between legitimate activity and genuinely suspicious stuff. This leads to much more precise risk scoring and, crucially, far fewer unnecessary alerts hitting the analysts' desks. AI also massively improves sanctions and PP screening politically exposed persons. It accurately checks names against constantly updated global lists, again, cutting down those time-consuming false positives. And maybe one of the most powerful applications is in suspicious activity reporting, or SARS. AI systems can flag suspicious activities and even automatically generate draft SARs for a human analyst to review.
Wow, generating the reports too.
Yeah, it dramatically cuts down the manual effort and speeds up the whole process of reporting potential crime to the authorities.
That sounds like a pretty radical overhaul. It really changes the day-to-day job for compliance teams, doesn't it? But is it just about, handing everything over to the machines, or is there still a vital human element needed in this new AI-driven world?
Oh, absolutely vital. It's definitely not about full automation replacing humans. It's about partnership, collaboration. The most effective compliance programs are using what's often called a human-in-the-loop model. AI does the heavy lifting, the data crunching, the pattern recognition, the routine automation. That gives you speed and scale you just can't get otherwise. But human experts are absolutely essential. They interpret the complex cases, they exercise nuanced judgment, especially on ambiguous situations. And critically, they adapt to emerging threats, new money laundering techniques that algorithms might not have seen before.
So the AI flags things, but the human makes the final call on the tricky stuff.
Precisely. This hybrid approach actually elevates the role of compliance professionals. They move away from being, essentially clerical workers drowning in alerts towards becoming strategic investigators. They can focus their skills on the high-value, complex work where human expertise is truly irreplaceable.
Right, that makes a lot of sense. Shifting gears a bit now,
Yeah.
let's talk about a newer frontier, one that's evolving incredibly fast. What about the world of cryptocurrencies, digital assets? How on earth do you even begin to apply traditional compliance rules, AML, KYC, in a space that feels so decentralized and sometimes pretty anonymous?
Yeah, that's a huge challenge, no question. And
Yeah.
it's one that has really forced a fundamental rethink of how we even approach compliance. The unique nature of these virtual assets, their decentralized operation, their global reach, the pseudonymity involved, the fact that transactions are often irreversible, it all makes them, frankly, prime targets for illicit activity. You have these virtual asset service providers, VASPs, like exchanges often operating globally, but maybe without a single clear entity responsible for everything that happens on their platform. And critically, you have unintermediated peer-to-peer transactions.
Meaning person to person directly, no bank involved.
Exactly. It bypasses the traditional financial institutions. It's like handing cash directly from one person to another, but digitally. So those traditional checkpoints, the scrutiny points, they just don't exist in the same way.
It seems almost impossible then. How could you possibly police every single transaction happening on a blockchain? There could be millions a day. How are regulators even trying to get their arms around this? Is there a practical way to bridge this gap?
Right. Well, it often feels like playing catch-up, for sure, but significant progress is being made. The FATF, for instance, has issued global standards specifically for VASPs. They require them to implement preventive measures pretty similar to traditional banks, things like CDD, record keeping, reporting suspicious transactions. A really key component of these standards is the travel rule.
The travel rule, what's that?
It basically mandates that when a VASP sends crypto on behalf of a customer, they have to obtain, hold, and transmit information about the sender, the originator, and the receiver, the beneficiary, along with the transfer, trying to mirror the information that travels with traditional wire transfers.
Okay, trying to bring some transparency there.
Right. But there's still a major tension point. While the hosted wallets, the ones provided by exchanges where they hold your keys, can comply with KYC, you have unhosted, non-custodial wallets, where the user controls their own keys, their own funds directly. These allow users to transact without providing any identification to a central party. That creates a pretty significant regulatory gap.
Right, so that's the core challenge.
Yeah.
How do you bring those unhosted wallets into the compliance fold without killing the innovation or, the whole point of decentralization for some people? Seems like a really tough nut to crack.
It is tough, but this is where some pragmatic innovation is stepping in. Rather than trying the impossible regulating every single on-chain transaction, the most promising approach seems to be focusing on the off-ramps.
Off-ramps, you mean where crypto gets turned back into regular money?
Exactly. The points where virtual assets are converted back into fiat currency, dollars, euros, pounds, whatever. At those specific junctures, traditional AML and KYC rules can be applied much more effectively. You can prevent the illicit proceeds from actually entering the conventional financial system. And this brings us to a really groundbreaking technological solution that's gaining traction: the AML compliance score.
A compliance score for crypto. How does that work?
It's fascinating, actually. It leverages the very transparency of public blockchains. Because the transaction history is public, you can trace the path of specific coins. So a diagnostic score, let's say, from 0 for clearly tainted funds up to 100 for demonstrably clean funds, can be assigned to a crypto asset based on its entire transaction history. For example, did this Bitcoin ever pass through an address known to be linked to ransomware, or sanctions evasion, or the dark web?
So like a credit score, but for the history of the coin itself.
Kind of, yeah. It enables exchanges or banks at that off-ramp point to make sophisticated risk-based decisions. Instead of a blind spot, you now have data to assess the risk associated with those specific funds before they enter the traditional system. It's a really clever way to use the tech itself for compliance.
That is a powerful concept. A traceable history score for crypto. So bringing this all together, what does this mean for the future of payments and for businesses trying to navigate all this complexity, trying to get compliance right without, completely alienating their legitimate customers with friction?
Well, that balance is absolutely critical. Finding that sweet spot between robust compliance and a smooth, frictionless user experience, it's paramount. Because overly burdensome KYC, making people jump through too many hoops, it leads to significant customer abandonment. That's a real business cost.
People just give up and go elsewhere.
Exactly. That's why the risk-based approach is so key. Using simplified due diligence for the majority of low-risk customers and reserving that deeper enhanced due diligence only for the genuinely high-risk accounts. Plus, Using automated, intuitive procedures, leveraging that tech we talked about, can really improve conversion rates during sign-up and build trust. It makes compliance feel less like an obstacle for most users. Internally, for the institutions themselves, the big push needs to be towards modernization and integration, getting away from those clunky, outdated, siloed systems and rigid workflows. A really strategic move we're seeing is implementing scalable architecture and, where it makes sense, combining the fraud prevention and AML teams into a single unit, sometimes called FRAML.
Fraud and AML together. FRAML.
Yeah. That integrated approach can lead to pretty significant cost savings, better efficiency, and just a more holistic view of financial crime risk overall.
And looking further ahead, it sounds like this compliance landscape is anything but static. You mentioned AI-powered adversaries earlier. How quickly are those threats evolving? Is it a constant arms race?
It absolutely is dynamic, and yes, it feels very much like an arms race. We're already seeing the growing threat of AI being used by the bad guys. Criminals are leveraging AI to create incredibly sophisticated synthetic identities, fake people that look real online. They're automating fraud attacks at a massive scale. They're finding new, complex ways to obscure illicit transactions. So compliance programs have to evolve technologically just to keep up. The future of AML compliance really lies in having adaptive, technology-driven programs with real-time analytics, flexible policy frameworks that can adjust quickly to new threats. Success is going to depend on leveraging technology for that efficiency and scale, and empowering those human experts for the complex judgment calls and strategic thinking that AI alone just can't do yet. It's about being proactive, constantly adapting, not just reacting after the fact.
Okay, so let's try and wrap this up. What we've really unpacked here is that AML and KYC are absolutely foundational pillars for financial integrity. Can't argue with that. But the traditional, manual, often siloed approach, it's just unsustainable. The costs are too high, the inefficiencies are too great, and the threats are evolving too quickly. The pivot to AI and automation isn't just nice to have. It seems critical for streamlining processes, boosting accuracy, and maybe finally getting beyond that multi-billion-dollar paradox we started with. But crucially, human expertise remains irreplaceable for that nuanced judgment, for strategy, for dealing with the unknown.
Absolutely. And the whole digital asset economy, crypto, it's definitely forced a major reevaluation. It's pushed the industry towards more pragmatic, risk-based approaches like focusing on those off-ramps and using clever tools like AML compliance scores to try and bridge that gap in a decentralized world.
Precisely. So this vision emerges of a hybrid compliance model, right? Technology providing the scale, the speed, the data analysis, human experts providing the strategic oversight, the complex decision making. And that's what potentially transforms compliance from being seen as just a burdensome cost center into hopefully a resilient strategic asset that protects the institution and its customers. Now, to leave you, our listeners, with a final thought to maybe chew on, think about this. As criminals increasingly leverage AI to automate fraud, to create those synthetic identities, how quickly do you think financial institutions can realistically adapt their defenses to keep pace? And what might that ongoing race mean for the future of digital trust in an increasingly AI-driven world? Thank you for joining us on this deep dive into the complex world of AML and KYC. We hope you'll continue your own exploration into this fascinating and absolutely critical area. Until next time.